All right, today we're diving into the Q2 2025 earnings for Churchill Downs. Now, this stock has had a pretty rough year, but management just came out with a record-breaking quarter and a really compelling story for what's next. So the big question on everyone's mind is, is this the turning point investors have been waiting for? Let's dig into the numbers and find out.
Okay, so the first thing you really got to see is this contradiction, right? On one hand, after the earnings dropped, the stock popped over 4%. I mean, that's a big thumbs up from the market. But then you zoom out and you see the stock is still down more than 20% over the last year. So that's the puzzle we're trying to solve today. Is this just a temporary bounce, or is it the start of a real comeback? So to figure that out, here's how we're going to break it down. First, we'll hit the Q2 snapshot. Then we'll unpack what's going on with the Kentucky Derby. There's a huge story there. After that, we'll look at their big expansion plans, some nice tailwinds on the capital and tax side, and then finally, we'll pull it all together for our rating on the next call.
All right, let's jump right into that Q2 snapshot. And really, to put it simply, this quarter was a monster. I mean, Churchill Downs didn't just squeak by expectations, they absolutely smashed them with a record-breaking performance all around. Yeah, just look at the numbers versus what Wall Street was expecting. It was a total clean sweep. They beat on earnings per share, they beat on revenue, and they delivered record-adjusted EBITDA. And we're not talking about beating by a penny here or there. This was a decisive beat that really, woke the market up. So let's put some real scale on that revenue number. We're talking almost $935 million. In a single quarter. That's up 5% from last year, which was already a strong year. And get this, it wasn't just a record for the second quarter, it was an all-time record for the company, ever. And all that strength on the top line, it flowed right down to the bottom, a record-adjusted EBITDA of more than $450 million. Now, here's the really crucial part. This is the 5th year in a row that they've set a new Q2 record for both revenue and profit. That's not a fluke, folks, that's a trend. That kind of consistency is exactly what you want to see. Okay, so a record quarter is great, but why? What's behind it? Well, let's start with their crown jewel, the Kentucky Derby. Management is signaling something really interesting here. They're not just talking about small, steady gains. They're talking about something they call step function growth, basically a massive leap forward. And here it is, straight from the CEO, Bill Carstanjen. He says, "We anticipate that we will generate step function growth for Derby Week in 2026. I mean, that's not just corporate speak. He's talking about a huge, game-changing jump in performance. That's a really bold statement to make, so let's see how they plan to actually pull it off. Okay, so they laid out a super clear 5-point plan for this. First, they're going to make more money from premium tickets, thanks to new renovations. Second, a brand new, much better broadcast contract with NBC is about to kick in. Third, and this one is a really big deal, they're moving the Kentucky Oaks race to a primetime TV spot. That's huge. Fourth, they're just going to keep building on the massive betting trends we're already seeing. And finally, all the money they've been putting into the racetrack itself is going to keep paying off. And all of this is built on a really powerful foundation. People are just watching the Derby more than ever. Viewership this year hit its highest levels in decades. We're talking average viewership of 6% and peak viewership up 8%. That's almost 22 million people tuning in. You see, that's why NBC is willing to pay up. That growing audience is what makes the whole new broadcast deal so valuable. And here's what that actually means in dollars and cents. Just from that new NBC deal, they're expecting a $10 million boost to adjusted EBITDA in 2026. Just like that. It's not a guess, it's not a hope, it's a clear, concrete number that's a huge piece of that step function growth they're talking about. But look, Churchill Downs is so much more than just a 2-day horse race, right? The other massive part of their growth story is this really aggressive expansion into gaming. And specifically, we're talking about historical racing machines, or HRMs. And this isn't some 5 years from now kind of plan. This is happening as we speak. They just expanded their place in Richmond. They're about to open a huge new property called The Rose in October. And they're actually ahead of schedule on that one. Then another big one, Marshall Yards, opens in Kentucky early next year. This is a real, tangible pipeline of new projects coming online. And it's not just about building new places from the ground up. They're also making some really smart acquisitions. They just announced they're buying Casino Salem in New Hampshire for $180 million. This is a huge move for them. It gets them a major foothold in the New England market, where they can start pulling in customers from right outside Boston. Okay, so how are they paying for all of this expansion? Well, that brings us to their capital strategy.
The company is getting a huge boost from some really powerful tailwinds, both in how they manage their money and from some new tax laws. And all this extra cash is fueling both their investments and their ability to give back to shareholders.
And speaking of returning cash to shareholders, check this out. They already bought back $250 million in stock last quarter. Now, the board has just authorized a new buyback program for $500 million. Let me be clear, that is a massive vote of confidence. Management is basically shouting from the rooftops that they think their own stock is cheap right now. So you might be wondering, where is all this extra cash for buybacks coming from? Well, a huge chunk of it is thanks to a new federal tax bill. There's this provision in it called 100% bonus depreciation. All that really means is when they build one of these new gaming venues, they get to write off the entire cost on their taxes immediately, instead of having to do it little by little over many years. It's a huge cash flow boost.
And here's the bottom line on that. Because of that tax change, management thinks they're going to save $50 to $60 million in cash taxes this year alone. And they expect about the same next year. I mean, that's just a massive infusion of free cash that they can turn right around and use for more growth and, yes, more share buybacks.
All right, so let's recap. We've got a record-breaking quarter. We have a crystal clear plan for a huge jump in growth from the Derby. We've got a pipeline of new projects that are actually getting built. And we have these powerful financial tailwinds just pouring cash into the company. So let's pull it all together and make our call. Look, the bull thesis here is incredibly strong. You've got point one, that step function growth coming from the Derby in 2026. Point two, a real tangible pipeline of new gaming venues opening soon. Point three, a huge cash infusion from those tax tailwinds. And point four, management is taking that cash and aggressively buying back their own stock. It's a pretty powerful combination. So when you put all of that together, our rating is outperform. We see a really clear path for the stock to move higher as all these catalysts start to hit. We're setting our 12-month price target at $138. Now, the thing to watch for next quarter is simple. Can they keep this momentum going, and can they successfully open the rows on time? If the answer is yes, then I think we can say this quarter really was the turning point everyone was hoping for.
And as always, just a quick reminder that this is for informational purposes only. It is not financial advice.